welcome back, ladies and gentlemen. You're listening to I don't know why I pointed there. That was cheesy. You're listening to another edition of DIY Money.
DIY Money.
Welcome, Logan.
Welcome.
What are you doing?
We're pointing.
We're pointing. We're on video. Check it out on YouTube. I tell you, when they turn the cameras on, it's like
chaos.
It's chaos. Hey, let's skip through all the nonsense today.
Yes.
Not that it's nonsense, because I do want to hear about your, meat adventures, I guess, and all the rest of the stuff that you're doing on the grill. But let's go right to Cory, because he's got a doozy. Cory, what do you got?
DIY! Hey, DIY team. This is Cory from Dallas with another question. Yeah, I have a taxable investment account that I've had open for about 4 years, and I've dollar cost averaged into that over that period of time. And I do have some individual equities as well as some ETFs that have done very well in that account. This was created with really just the intention to invest and, grow that money over the long term. I didn't factor any of that into any savings goals or other financial goals. So I guess I'm just asking what are ways to think about or maybe approach outsized gains and maybe the potential of using it to advance savings goals or to start a business, things like that. I just wanted to hear you guys' thoughts on that, or maybe it's best to not touch it and let those winners continue to run. So yeah, would just love any feedback or advice you guys had on that. You guys have a great day.
Okay, Cory, great question. I'm guessing he sent this before the bloodbath that's transpiring in the market right now. Yes. And he's like, would they get to the question, please? Because I'm losing money by the day.
Yes.
So I'm going to approach this in a couple different ways, Cory. The first way I'm going to approach it, and I'm not sure what I'll leave you, but I'll do my best to leave you something.
That sounds about right.
So the first way I'm going to approach this is if you have a taxable account, the taxable account is there either for another leg of the retirement stool, or you have some sort of goal that's 5 years or more than you're saving for, right? So 5 years or less, we always say don't invest. So if this is a taxable investment account, it should be serving one of two purposes. The first purpose is, hey, I want to retire before I'm accessing my retirement accounts. I'm going to build this account up over time, and then I'll potentially use this account pre-retirement accounts for tax purposes often. The second could be, you know what, we may want to buy a house in the future, or we want to do something in the future, and kids' college or whatever, custodial accounts, whatever it might be. It's beyond the 5-year window. You're investing for that. And as you get closer to that goal, it's a pure kind of like mathematics the wrong way, unemotional way of delevering that. So sort of reducing the allocation over time, just like you would be doing if you were approaching retirement, when you're going to be basically using that money. So for example, my son, custodial account, and investing on his behalf, as he's been getting closer to using the money for college, we are backing off risk, and I'm very happy that I'm doing that. Now, that's the first thing I'll say, and that's pretty simple, but I'm guessing you're not talking about that. I'm guessing you're talking about a couple of positions that have run considerably, and now you're like, oh crap, what do I do? Well, in that case, I would circle back around to why you bought them. Now, Cory, I'm going to carve out ETFs, and I'm going to carve out ETFs because ETFs should be evolving and changing over time, that you shouldn't need to do much for them. In fact, I've talked about this often, and that would be your index baskets, etc. I wish 20 years ago I did nothing but that, right? Because then I wouldn't have some of the challenges that I even have now with individual equities. But let's say you have a couple of stocks. You found out about a company, you liked it, and you bought it, and now you've had this massive gain, and you're not quite sure to trim, to take gains, etc. The reason I say I circle back around to why you bought it is because if you bought it for any other reason than actually doing research, you are gambling. And what do I mean by that? Like, if you had a fundamental reason, you understood the balance sheet, the income statement, figured out what they were making, et cetera, yada, yada, or maybe not so fundamental, but you love their products, like you pulled a Peter Lynch and you were like, I love these products, I love their shoes, I love their clothes, whatever. Well, do you still love their products? Do you still love their shoes? Do you still love their clothes? Because if that's the case, why are you selling them? Right. Why would you be selling? Just because it went up? That's not a very good excuse to sell them just because they went up. I mean, if you look at a Warren Buffett, he's held positions in his portfolio for 60 plus years. I mean, some of these positions he's held, Coca-Cola, for something like 60 years. So there's no reason in that instance just because it's appreciated to sell. However, if for a fundamental reason, this is what happens to me a lot, is I'll dive into a company and I like the fundamentals. I could name a plethora of them over the last couple of years. The fundamentals are interesting to me for a variety of reasons. And then all of a sudden, the stock catches fire, and the price of the stock or the value of the company all of a sudden far exceeds the fundamental value of that business, like well beyond. And I look at that and I go, okay, we have now gone from an undervalued stock or something that I thought was undervalued. It approached being valued, and now it became absurdly overvalued. And that's when yours truly will often either sell, I hate doing that because I hate paying taxes, or I will gift some of that, and I will do the donor-advised fund strategy that we've talked about a lot on this podcast. But that's when I'm doing the fundamental sort of valuation of a company. And it doesn't have to be, I'm not like running discounted cash flow. I mean, there's a particular stock that was outstanding, and the whole premise was this company's not yet profitable. I think they're going to be profitable. The CEO is writing about how he wants to be profitable. It's his main goal. He wanted to be entered into the S&P 500. And I said, if they become profitable, this is a very cheap stock. Well, they became profitable. The stock moved in lockstep with that profitability. And then, like a catapult, the stock went absurdly beyond, selling at valuation metrics that were stupid. Now, if I'm over your head with that and you're saying, I didn't do any of that, then please understand you're speculating and or gambling, and you have to be very careful. Because I've watched people who have found a stock, found an idea, invested in it, rode it high, thought they were a genius, only to give it all back, and you don't want to do that either. What say you, Logan?
Yeah, I mean, you can go into a lot of depth and detail to the different things that you're talking about. I think it's really, really important. I'm going to focus more on your first point, is anytime that you have an investment, anytime you're putting money into an account, there should be a goal or a tag assigned to that of what the goal is for those investments and for that particular account as a broad category. So if you're going in and you're buying Google in your joint investment account, why are you owning that company, the research that you're talking about, and why are you buying that? Are you buying it for, okay, hopefully in 2 years you can flip out of it and buy something, or are you buying it for a long-term retirement goal in a plan for the future? So having the goal designated for, he said at the very beginning of his question, yeah, I just opened this joint account, started throwing money in it. Not really a great reason to start opening a joint account and start investing. Because if you have goals on the horizon, if you're going to buy a house within 5 years and you want to have that money just sitting in money market, or if you're going to have some other goals in a near term, your investments should really be strategic in order to meet those goals of the designated account. Because if you're going to use that money in 6 or 7 years, you're probably not 100% invested in stocks. And you might be even more broad-based indexed exposure versus taking a little bit of piece here and there in individual stocks as well. So you really want to dive into the details and understand, what is the purpose of this account? What is the purpose of me putting money here and buying these different companies? And what is the research I've done in order to own them? And then also, I think people lose it a little bit on, well, I can just buy index. I don't have to do any research at all. I think it's important, too, to also understand what a diversified portfolio looks like. And when you're early on in your career, maybe you just buy the S&P 500 because you're trying to learn about the market. But as you get later on down the investing road, it's important also to understand why you add diversification to your portfolio. We're seeing that play out this year. Having diversification is helping people a lot in their portfolios for those other areas that have done well when the S&P 500 isn't. So it's really about goals, priorities, and understanding what the timeline is and doing research on all of these different things.
That's great. Cory, hopefully that answers your question. Again, I think it comes back to a plan from the very beginning, is understanding a plan. Even though this, at least the time you sent the question in, the plan went well and the stock's appreciated, but there are times people will enter the market or an investment without a plan, they don't go well, and then all of a sudden they make irrational, emotional decisions, and it really came back to the very beginning. With a plan, you will absolutely help yourself from making those devastating decisions during the heat of the moment. Thanks so much for that question. We'll send you a $25 Amazon gift card. We need questions, so keep them coming. Please do send them in. podcast@DIYmoney.org. That's podcast@DIYmoney.org. And remember, friends, the secret to wealth is pretty simple. Live on less than you make. Invest the rest. Do so for a very long time. Make it a great one.